Good afternoon, ladies and gentlemen. Welcome back to our weekly market review. Today, I have my co-host with me, Mr. Gerald Wong. How was your weekend, Gerald?
Well, it was another busy weekend with more visiting with family and friends. So I think that will probably continue for the next few days as well. Have quite a number of low hay this week as we continue with the Chinese New Year festivities.
Yes, talking about that, I lost count of how many steamboat dinner I have been having in the past 1 week, especially over the weekend. It's like, oh, everywhere you go, it's like having steamboat kind of a meal. So looking forward to one more week of Chinese New Year celebration. But then STI last week, the local market actually have a very good performance. So will you be helping us to break down the what was happening last week on the
Yeah.
local markets?
So quite a number of good news that we see that I will share over today's weekly market review. Before that, just as a disclaimer, today's session is for information purposes only and should not be taken to be financial advice. Okay, we have an upcoming SIAS that's happening this Wednesday, so that's keeping Sunny and I busy this week as well. It is exclusively for SIAS members only, and you'll have a chance to be able to ask us any questions that you might have, especially after the various weekly market reviews that you have attended. Okay, if you find today's session helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can go to this website, scan this QR code, and the membership for SIAS will cost $12 per year or only $1 per month. Okay, so this is effectively what Sunny was sharing earlier. We have seen a very strong performance by the STI last week with gains of 2.7%. You rarely see such a strong move within a week. And more interestingly, this is in a backdrop of actually the US indices coming down. Okay, so we see S&P 500 losing some ground by 0.4%, but still staying above the 5,000 level. And this is actually led by the tech stocks because we see that the Nasdaq was down by 1.3%. Okay, so what was the macro news that actually moved the market last week? We saw that US inflation was higher than expected. Okay, the January CPI rose by 3.1% compared to the previous year. So while this actually moderated from the December level, it was actually higher than what investors were expecting. Based on what the consensus number was, market was expecting that the CPI will grow by 2.9% in January, but actually came through hotter than expected. Okay, so this is actually indicating that inflation might be a bit stickier compared to what investors were expecting, and this might actually slow down the pace of potential US Federal Reserve interest rate cuts. Okay, so what we see here is that the US government bond yield has rebounded. Okay, if we were to look at the 2-year Treasury yield, now back to 4.6%. And if I were to compare that to late January was only at 4.2%. Okay, if I compare that to somewhere in the middle of January, then it actually went close to 4.15%. Okay, so quite a big move up once again after the US economic data came in very strongly and inflation actually shows very little signs of coming down in a very sharp pace. Okay, so all in, we are seeing that investors are cutting back their expectations of a very rapid rate cut by the Fed. If you recall previously, some investors were expecting that the first rate cut might come through in March, but based on the latest data that I put through yesterday, effectively what we are looking at is that investors are not expecting the rate to be maintained in March and likewise in May this year. This means that the first rate cut may only happen in June, which is later than what we were expecting or what we see in terms of the market expectations at the start of this year, because of the hotter than expected inflation data. Okay, so we see the very strong performance by the STI. We saw within the STI component stocks, quite a number of names actually seeing gains of 4 to 5%. Okay, what actually stood out is Singapore Airlines having gains of 8% in the past week. Okay, this is at the back of a broker upgrade as well as expectations that the yield of SIA will remain high going into the coming year. Okay, outside of that, we have DBS gaining 4.3%. We did a review of the DBS results last week. So if you missed it, do go back and look at the weekly market review for last week, where we discussed the increase in dividends as well as the bonus share issue. Okay, outside of this, we have got Sembcorp Industries gaining 4.3%, Genting Singapore gaining by 4%, and Imperador with gains of 4%. Okay, so quite a number of STI stocks actually doing well. In terms of the worst performers, we have got the Jardine related names. So Jardine Matheson down 3.2%, Jardine Second Carriage down 2%, CICT down 1.5%, Wilmar 0.6%, and UOL 0.3%. Okay, so all in, it seems like the gainers are actually exceeding the losers, which actually explain the very strong gains by the STI last week. Okay, so for today, we are going to be talking about two REITs. The first one is Keppel Pacific US REIT, one of the names that got a lot of investor interest in the past week because of the announcement that they will be suspending distributions. So as a result, we see this very sharp fall in the share price of Keppel Pacific US REIT by about 40% in one day, and pulling down quite a number of other REITs with US assets as well. Okay, so what actually happened to Keppel Pacific US REIT? Let us try to understand it a bit better. So this was actually what they announced in terms of their performance in the second half of 2023. If we're to look at the gross revenue and net property income of Keppel Pacific US REIT, it actually was still fairly resilient in the second half of 2023. Okay, so what we see here is that the gross revenue grew by 1.3% compared to the previous year. Net property income gaining by 2.3% compared to the previous year. Okay, but what affected the REIT's income available for distribution was a spike in the financing cost. And with that, the income available for distribution came down by 10.1% to 26 million. Okay, so while there was income that was available for distribution, the REIT manager decided to suspend distributions, which is why you don't see any distributions for the second half of 2023. Okay. So firstly, we look at the revenue, and what we see here is that the occupancy of Keppel Pacific US REIT is slightly better than what we see for the other US office REITs. Okay, so if you were to look at the occupancy at the third quarter of 2023, 91.4%. And if you were to look at, say, others such as Prime, Manulife US REIT, they have fallen by a sharper extent. Okay, so this 2.2 percentage points fall in the occupancy rate of core also has outperformed the US average, as well as the US 4 and 5 star building average. So with the still fairly resilient occupancy, that has actually explained why it's been able to maintain fairly resilient revenue for the second half of 2023. Okay. Okay, but what happened is that they had to see a revaluation downwards of the assets that they own. Okay, so across the entire portfolio, we see that the total portfolio value came down by 6.8%. Okay, compared to the end of 2022. Okay, this is a reflection of the higher interest rate environment, as well as the weaker outlook across US office assets. So in total, the total portfolio value came down by 6.8%, and that actually impacted its gearing level. Okay, so what we see here is that the average aggregate leverage went up to 43.2% because of the valuation update where the property values came down by 6.8%. And this is something that caused some concern amongst the manager of Keppel Pacific Oak US REIT. Okay, we see here that the average cost of debt is at about 4% per annum. And in terms of the debt maturity profile, about 12.5% of the debt is due in the fourth quarter of this year. And then you've got another massive 25.7% of debt that is actually due in 2025. Okay, so this is something to actually pay attention to because effectively what this means is that it's got close to 38% of all its debt actually due for repayment over the next 2 years. And this is something that the manager has also considered in deciding to suspend the distributions. Okay, so effectively what they have announced is that the dividends will be suspended beginning the second half of 2023. And this will be all the way at least through the second half of 2025 distribution that will be paid in the first half of 2026. Okay, so I mentioned earlier, this is taking into consideration the increase in gearing to 43.2% as at December 2023. So based on the discussion that Core has with the banks, some of them have indicated that they are reluctant to extend borrowing above the 45% leverage ratio. And this is actually quite close to Core's current gearing of 43.2%. Okay, so on top of that, you've got additional capital requirements to keep the office buildings competitive, to be able to keep the tenants. Otherwise, you might see a further decline in the occupancy rate. And then there is a risk that the valuation of the property assets might be revalued downwards once again come December 2024. So that leaves very little room to maneuver, especially if banks were to be reluctant to extend borrowing above this 45% leverage ratio. Okay, so some of the other options that the manager actually explored would include divestments, equity fundraising, as well as a reduction of distributions. But they actually found that this suspension of distributions will probably be the option that seems most viable. So for divestments, given the outlook of the US office market, it might not be feasible because it might mean that they will have to sell the assets at depressed valuation. And likewise, given the share price of Keppel Pacific Oak US REIT and the demand for further equity fundraising might be fairly limited. So effectively, what the REIT manager has decided is that by conserving this capital and suspending the dividend, it would actually make more sense to them compared to these other options. Okay, so that is really an update of Keppel Pacific Oak US REIT, why it suspended its distributions and why its share price came down so sharply last week. Okay, next we have ESR Logos REIT, another name that we get asked very often, and we actually hosted the Corporate Connect with the REIT manager last week. Okay, so fairly resilient share price performance for ESR Logos REIT. You see this dip in October, but since then has rebounded strongly from about 25 cents to 32 cents and has actually stayed at close to this level over the course of 2024. Okay, so in case you are not familiar with ESR Logos REIT, in terms of the portfolio breakdown, you've got about 63% of the portfolio in new economy sectors. Okay, and actually most of these are multi-tenanted buildings. Okay, in terms of the breakdown by geography, you've got about 80% of assets in Singapore, but also assets in Australia as well as in Japan. Okay, so this is what the REIT reported in the second half of 2023. You see this decline in revenue as well as net property income. And together with the increase in financing costs, the amount available for distributions came down by about 11.9%. Okay, but because of the fundraising that was done, there is additional units for the calculation of the DPU. So as a whole, the distribution per unit actually came down by 23% compared to the second half of 2022. Okay, so what we see here in terms of the occupancy is that it has been fairly stable across the entire portfolio at about 92.8% for FY 2023. Okay, this is actually consistent across Singapore, Australia, and Japan, where actually the portfolio of Australia and Japan is close to 100% occupancy. And then the Singapore portfolio is at about 90%, slightly better than the JTC average of 89%. Okay. In terms of the rental reversions, they were able to record positive rental reversions of 11% for the whole of 2023. And this was actually led by the high-spec industrial assets. We saw the rental reversions of close to 20%. Okay, so this is actually the balance sheet of ESR Logos REIT. We see that the aggregate leverage is at about 36% now after the fundraising exercise that was done. And this is actually down from the 42% as at 31st December 2022. Okay. The weighted average all-in cost of debt has risen to about 3.9%, and that actually explains the higher financing costs and the decrease in the income available for distribution. And what we see here is that it's got most of the interest rate actually fixed. So about 82% of the interest rate now fixed, and effectively limiting the impact of further increase in interest rate towards its financing cost. Okay, so with the lower leverage, it has got a higher debt headroom as well, now of 775 million. So that also gives it some ammunition for the potential acquisition of assets if it wished to be doing so. Okay, so if I were to look at the valuation of ESR Logos REIT now at about 1x price to book, I mentioned that it is one of the fairly resilient REIT in terms of the share price performance, and that's actually caused the price to book valuation to go back up to about 1x. Okay, so we have quite a busy week that is ahead. First and foremost, in terms of the macro, we have the FOMC meeting minutes that's coming up on Thursday. But in the Singapore market as well, we've got quite a number of large cap stocks that are reporting their results. So UOB on Thursday, likewise Genting Singapore on Thursday as well. And then for many of you who are watching out for the Singapore Airlines results, that is coming up tomorrow on the 20th of Feb. Okay, for those of you who are following the US market closely, what everyone is looking out for would be NVIDIA results, which is coming up on Wednesday, because that will set the momentum of the US tech stocks and determine whether the AI rally will actually continue. Okay, so with that, I'll hand over to Sunny, who will share with us what the indicators are looking like and whether the rally that we see can actually continue.
Thanks, Gerald, for the insightful sharing and diving into the balance sheet or the financial statements of the counters that you covered. So let me do a roundup. So Gerald talked about the FOMC rate earlier on, and I'm of the view that maybe we would not see, even though the percentage now is 66%, we are likely to see the May rates is expected to stay the same, and we are only expecting a rate cut as early as June, but that's at the 53% mark, which is also a very narrow margin. My view is that maybe it will also not happen in June and may happen even late towards the later part of the year. Why do I say that? If we look at the economic calendar, that was the data that was released last week, Gerald touched on the core CPI data earlier on, which shows that inflation is very sticky. But another problem that we observed last week was towards the end of last week, we also have the PPI data, which is the Producers Price Index. Now, this number also came in hotter than the previous month number, as well as the market consensus. So what is the PPI number? The PPI number is basically what the producers pay as a wholesale price. Now, this producer price index, right, or the data, right, eventually towards the next few months, it will filter into the CPI data, because this is what producers pay on the wholesale price basis, and producers may pass on the cost to consumer, and that will cause the CPI, the inflation rate, to go up again in the next few months. So that is why inflation is likely going to look very sticky in the next few months, until at least we see some signs of the PPI data reading starts to come down again. And what that means is, if the inflation number were to stay high, then the rate cut figures will not likely come down anytime soon. That's why my thought or my opinion for now is maybe it will not be in June even. It may be later, maybe in I think the earliest would be July, I believe. And then of course, if July doesn't happen, maybe the September period it will happen. So I am more towards the interest rate only coming down towards the later part of the year. And there are already some talks in the market right now that maybe we would not even see a rate cut this year. But then that is still yet to be determined until we have more data. But those are some kind of scenario that will pan out towards the later part of this year. So this is something that you might want to take note of. And if interest rate were to stay high, that may also explain why the STI has been going up. Because if we look at earlier part of the period last year, especially if you look at the banks, right, which is the beneficiary of high interest rates. So if the interest rate were to stay higher, then definitely the performance of banking stocks in Singapore will also go up. And that is also part of the reason why we can see that DBS Bank share price went up so much in the last week or so, on top of the excellent data, excellent earnings results that they have also published. Okay, so same for the other banks, UOB as well. You can see UOB has not reported their earnings, although it's coming on the 22nd of February. So this explains why the banks are going up. And as we know, the three local banks are the main constituents or have the most heaviest weightage on the STI index. So that is also why STI had a very good performance last week, up 2.7%. So back to zooming in on the STI chart. So I think in the last couple of weeks, we have been saying that I'm not going to get into STI index until we reach the 3,100 level. And that sort of happened somewhere last Wednesday, 14th of February, which is also Valentine's Day. So the stock market is something like another girlfriend that I know quite familiar with. So the STI index actually came down to a low of about 3,092 points. So at the 3,100 points, I decided that this was the first shot that we can take on the STI index for at least a technical rebound to happen. And after that, you can see the next few days on Thursday and Friday, it went up by 2.7% for the whole week. So you can see, if I'm going to draw out the gains on that few days, that will be about 4 point something percent. Let me pull out the figures for you. Okay, label. Okay, so that's about 4.42% from the 14th of February low to the Friday, 16th February high. That's about a 4.42% gain. So where will the STI go from here? So this morning, we can see that STI is more or less largely flat, but you can see that the banks, the DBS Bank, the UOB, and the OCBC Bank, they are still marching higher. So where the STI will likely be headed, I believe this gray shaded area here is the indication that we have. We are likely to retest the high in December, which is the 3,250 level. So now we are at 3,222. So we are about 30 points away from this level, 3,250. And that is where I believe the first resistance level, the first level of resistance will appear, and there might be some profit taking over this area. So if we reach this target, I will close off the position of the STI index at the 3,250 level. Now, why is that so? If you look further into the chart to the technical indicators, you can see that the MACD indicator is still a positive reading, and the divergence between the MACD and the signal line is still sort of a widening upwards. So that means that there's more upside towards the STI index to come. So we have not faced a situation or any indication that we are going to see a retracement or a pullback from the MACD indicator yet. Hence, my opinion that STI will march towards the 3,250 level. On the RSI, we can see the RSI actually went from the under 50 neutral point last week to to all the way last Friday or today that we see at 63-point level, which is a healthy reading, healthy kind of uptrend momentum reading. And we have yet to test the 70-point, which is the overbought mark where we will see a pullback. So the RSI also telling us that we still have some upside to go on the Straits Times Index. So where would the RSI most likely hit? If you look at the December high of the STI index, the RSI actually hit a 75 points level. So even if it's touched the 70-point level of the overbought level, we may still have a little bit more upside towards the 75-point level before we see a pullback of the STI index, much like what we see here during the December period. Okay, so a lot of indicators and a lot of chart readings are pointing to us that the STI is continuing to rise further ahead in the next 1 or 2 weeks. And if you look at the earnings calendar, like what Gerald touched on earlier, we have the UOB Bank reporting this week and Genting Singapore. If you take a leaf from DBS Bank's result and if you take a leaf of the SIA performance recently, these are two similar counters with the same kind of industry or background that will have the same kind of performance of what DBS and SIA has been experiencing recently. So all these points all together to my thesis at least that the STI is going to extend further upwards towards the 3250 level. Next, let's go on to the US side. So we had a bit of pullback on the Dow Jones Index as well as the 3 other major indices. The main reason, of course, we said earlier, because interest rate is unlikely to come down anytime soon. And the inflation data is very hot. The PPI data is also very hot, which will translate into the next few months of the CPI data, I believe. So that is why a market is sort of taking a break from the uptrend that we are seeing right now. So the highest that we have seen on the Dow Jones Index recently was at the 38,927 points level. And then we have a bit of a pullback last Friday. Now you can see this 20 days moving average or the Bollinger Band basis, the black or the green line over here is now a support for the Dow Jones Index. If you look at the behavior of the candlesticks against the Bollinger Band basis, it has been trending quite a gap above the 20 days moving average. And recently it has come down towards the 20 days moving average. This is a sign that the uptrend that we are experiencing has been losing a little bit of momentum already. But of course, we are also coming to the end of the earnings season. So that is why there may not be much of a catalyst going forward. And on top of that, the high interest rate is limiting the further upside gains from the US indices. So the support level that we are still looking at for the Dow Jones Index definitely will be the 20 days moving average, but it may be capped at the recent high that we saw on 12th of February, which is the 38,927 points level. So this is a level that you might want to watch and take some profit off if you have some investment on the Dow Jones Index. So it may become a very sticky level. And if we are unable to break through further, profit taking will come in and push the index down towards the 20 days or even the 50 days moving average at 37,592 points level. On the MACD indicator, we can see that it's a slightly negative reading on the MACD indicator, meaning that the MACD line has crossed below the signal line. So there is, at the moment, there is a negative momentum or downtrend momentum according to the MACD indicator. On the RSI, we have also come down from the high of 72 points, which is slightly above the 70-point overbought mark. And we have also broke below the 14 days moving average of the RSI on the 12th of February last Monday. So that means that we are seeing a downside movement. Although the momentum is still pretty positive, but the trend looks to be coming down according to the RSI indicator. So would I bet against the Dow Jones Index or would I short the Dow Jones Index? The answer is no, because I think the macroeconomic front of the US is still very strong. We are still seeing very strong numbers from the companies. We are still seeing very strong numbers on the employment side of things as well in US. So I think the rally is going to continue, but just that the momentum is going to slow down. Hence, I'm not inclined to short the US indices. I'm more inclined to wait for a pullback towards a a more sustainable support level before considering getting back into the Dow Jones Index again or the major US indices. So that level would definitely be, to me, would be the 50 days moving average, which is the 37,592 points level, which is the blue line that you see here, which is the exponential moving average of the 50 days. So that's my take on the Dow Jones Index. Next, let's move to the broad index of the S&P 500. So we can see here S&P 500 year-to-date high is at 5048, and we still managed to close slightly above the 5,000 psychological handle last week. But will this be able to hold up? I'm not very sure. So the indicators, MACD is telling us a negative reading, so negative momentum now in the S&P 500 index points, and the RSI is also trending downwards, has come down below the 70-point overbought mark, and we are trending downwards. We are now even below the 14 days RSI moving average reading as well. So that is another sign that the index might have peaked in the near term, and we are looking for a pullback. So the next level, of course, you have the 20 days moving average, which if the uptrend momentum of this continue, it will bounce on the 20 days moving average. But based on the indicator right now, I don't think that the 20 days moving average will provide that support. Or I would say on the more conservative side for myself, I would look at the 50 days moving average around the 4,817 points level. That may also coincide with the previous level that we are looking at, which is the 2022 January high at 4,818 points level. So this level, 4,818, 4,817, will likely provide a very strong support for the S&P 500 index. Next, let's move to the Nasdaq Composite Index. So Nasdaq Composite Index, we can see suffered the heaviest loss last week, or because the tech stocks are also very sensitive to the interest rate movement. So if interest rates are not likely to come down soon, of course, the tech stock will be the most adversely affected. So we've seen a high reaching, let me see, what's that level? 16,000, not yet the 16,000 level, but we are at on the 12th of February, we reached a high of 16,080 points level for the Nasdaq Composite Index. So we are now at the 15,775 points level. So are we able to retest this level again? I believe the answer is yes, but not until we found a firmer support level. So the next support level, 20 days moving average, would be a continuation kind of a support level you look at. If you believe that the past few months trends is likely to continue, then you will take the 20 days moving average as a continuation of the previous trend as a support level for that trend. But if you think that we might see a slightly bigger pullback, then the 50 days moving average would be your next target, which is around the 15,151 points level. Then that would become a stronger support for the Nasdaq Composite Index. The MACD histogram is still negative right now, so negative momentum in the Nasdaq Composite Index right now. So expect some pullback until at least the 20 days moving average. Then we can relook at the MACD again. RSI has gone down from the high that we saw on 29th of January at 73 points. Now we are at about 58 points. So that is also coming down as well. And it's also below the 14 days moving average of the RSI. So definitely we are seeing some kind of a loss of momentum of the uptrend that we saw among the three major US index. So do brace yourself for a bit more of a pullback before you get into the major US market indices. So that's all I have for this week update on the weekly market review. Gerald, final words, your thoughts on what we shared.
So another busy week of results ahead. I think the UOB results is definitely something that we are all looking out very closely for. Likewise for NVIDIA results. So while you are actually continuing to enjoy your lo hei, bak kwa, and for Sunny, your steamboat, those are the things that we'll keep a lookout for to monitor how the market will move from current levels.
Yes, so I'm very excited ahead for the local markets, the STI, or especially on the earnings of UOB and Genting as well. I believe that will be the next catalyst where it will push the STI up to the next level, or at least the next resistance level. So we will continue to update you guys here on our weekly market review. And I think that's all the time that we have for this week. And we'll see you again next Monday, same time, same place, same channel. So thank you for watching this week weekly market review, and we'll see you again next week. in the next weekly market review. Thank you.
See you.